Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, today I want to get back to 3 basic rules of investing, and I'm going to specifically talk about 3 rules for stocks today. And by the way, if you find value in this video, if you see it on Facebook or LinkedIn, or if you get it in an email, go ahead and forward it or share it with a friend. So let's jump in. 3 simple rules for investing. And I wanted just to share this with you because I find, actually, let me zoom out for a second. I'm finding that because markets are near or at all-time high and asset classes like, for example, Bitcoin, have done really, really well, people sometimes are getting a little, in my opinion, off track in terms of what their goals are. So I want to get back to what some basics are with respect to investing. So again, 3 simple rules for investing. So let's go through this one by one, and I'll dive into this a little deeper. So number 1, invest in companies with good products and services. Number 2, don't be in a hurry to sell. 3 here on this list, don't be spooked by bear markets. So let's jump into the first one. Invest in good companies. Now, as you know, companies exist to make goods and services. In an ideal situation, they exist to make great goods and services. So what we want to do is buy stocks in a company that makes good products. This is kind of obvious, right? But I think sometimes people just, maybe again, they get distracted or they read a headline and sometimes they jump and buy stocks that, in my opinion, aren't as ideal. Well, what's a great company, at least for the last 20 or 30 years? That company, as you likely know, is Apple. You probably own some or many of their products. Of course, they have laptops, they have the famous iPhone, they of course make computers, iPods, they make earbuds, all these printers. They make a ton of terrific products that obviously people need. People consume these products many times hourly per day. Invest in great companies that make great products and services. Number 2, don't be in a hurry to sell. The markets have run up for some years now, but don't be in a hurry to sell. If a stock is working, absolutely focus on the long haul. And companies are going to have challenges. So I remember some years ago, as an example, Chipotle, which is a very good fast food company, very good as in profit, they're very profitable historically. Well, they had a challenge, I believe, with E. coli some years ago. Some of their meat products obviously had some challenges with them. The stock took a short-term tumble, but ultimately they figured out what their challenges were. They overcame that health scare, and the company continues to have success. Again, that's an example. So sometimes you're going to see some short-term downturns because a company is going to have challenge, but especially if a company has a proven track record of success and a strong outlook for the future, you'll likely want to hold that stock. This doesn't mean you should never sell. If a company, though, has products that are trending down and are not desirable in the marketplace, or if the company simply doesn't make adjustments with what the trends are in terms of, for example, technology, that's a stock you might consider selling. I'm going to show you an example. What stock is this? This is a stock of a previously popular company. What stock is this? This stock, you might recall, this is Kodak. You remember back in the day, Kodak was the number one, or at least one of the top camera companies back in the 80s and 90s. Well, the challenge Kodak had was they didn't change with the times. They didn't transition their business from film to digital photography and video. So again, they didn't keep up with the time. In fact, Kodak thought back then it was a fad. Kodak, obviously, look at the stock price. This is a company that, again, didn't keep up with their trends. If you still own Kodak stock, I would wonder why. But the trend is not your friend here, and you should have jumped off the boat years ago if you still own Kodak stock. If the company is trending down, if they're not keeping up with the times, clearly, as an example, in Kodak situation, you're not going to want to own that stock. Rule number 3, don't be spooked by bear markets. You might recall that a bear market is when a stock or an index like an S&P or a NASDAQ falls 20% or more off of its high. This again is referred to as a bear market. This occurs about once out of every 5 years. We had one in 2022, and obviously the markets have recovered. Now, I want you to remember, now when you're investing, you got to think long term, this later bucket. Ideally, you're going to have your money split up into 3 different buckets: short-term money, medium-term money, and money for the future. The money that I'm talking about when investing in stocks, and specifically when thinking for the long term, is this later bucket. This is money that ideally you're going to need in 10, 15, 20 plus years from now. So if we have a bear market where the stock goes down, say 20%, or even an index like the S&P or NASDAQ goes down 20 or more percent, if it's a good quality company that makes great products, and generally speaking, again, that's a short-term bear market downturn, generally speaking, the market trend and or the stock trend is long-term, presumably positive, you're likely to want to hang on to that stock. 3 rules for investing. Let's go over them one more time. Again, simple rules. Invest in companies with good products and services. Don't be in a hurry to sell. Don't sell too soon or be spooked out by a bear market. I wanted to get back to some basics because I know, again, the markets are doing really well. Sometimes people lose track of having rules when developing an investment strategy. So don't forget, speaking of that, you got to make sure you have these 4 things, in my opinion. Number 1, clarity on your goals. Number 2, risk tolerance. Make sure you understand what your tolerance for risk is. Number 3, have a growth and protection investment strategy. And absolutely, you must need to know what your family index number. That is the rate of return that you need to earn now and in the future, on average, to live the life you want. If you found value in this video, again, don't forget to share it on social media, Facebook or LinkedIn. And if you get it in email, go ahead and forward it to a friend. To that end, if you would like a second opinion on your portfolio or financial situation, this is our website at nicholswealth.com. Click on the upper right-hand tab, this request an appointment tab, fill out the information, and one of our advisors will reach out to you, answer your questions. Hopefully you're having success with the markets. Thanks again for watching. Bye-bye.